Okay, so hopefully that's given everybody an opportunity to log on to the webinar. So just want to say good afternoon to everybody and welcome to our second webinar of our series. The first webinar basically set the scene for inheritance tax, and Andrew and Glenn took us through the elements of that. Today is really all about the planning toolkit and some of the personal planning opportunities that could become available to people. So let's move into our webinar. So I'm going to introduce all of our speakers today. You've got myself. I am the Tax Compliance Director here at Prime, and I facilitate working on people's tax returns and the advisory team with any parts of planning that's needed. Our next speaker is Glenn. Glenn is our financial advisor. He is the Director of Prime Wealth Planning. So he will be going through any of the independent advice points that he will be discussing today. And then finally, we've got Andrew. Andrew is our inheritance tax and trust specialist. Andrew's written many articles and he has a massive depth of knowledge on the area. So he'll be here as well to answer any questions and talk us through certain elements of the webinar. Glenn, do you want to take us through the starts of the webinar, please?
Great, thanks, Paisley. Good afternoon, everybody. Yeah, so today we're hoping to cover, really, we'll start off with a reminder of where we got to from inheritance tax. There's a whole range of people on the webinar today, I'm sure, with different levels of experience and familiarity with the tax itself. So we'll try and pitch it so it covers something for everybody. We'll talk about what we can do about inheritance tax and what planning opportunities you could consider. I'll exemplify that with a few scenarios, and Andrew will kind of chip in as well on some of the more complex tax areas. And then really kind of leave you hopefully with a feeling about what it feels like to experience a high quality independent financial planning process, because it's one thing for us to touch on the different planning tools available to you, but which tools to use and which are best suited for yourself and your circumstances, that really is down to the whole advice process. So rather than just giving you a whole raft of information and leaving you confused, we'll try and show you how the way forward.
Great.
So just I thought,
No, I was going to say, it's great, Glenn. If anybody has any questions as we go through the webinar, please do add them to the Q&A function and we will try and cover off what we can at the end for anybody as we go through.
So a quick reminder of the rules. So but before April this year, when things started to change, we have typically a spousal exemption, so you can leave unlimited sums between yourself and your spouse without inheritance tax being an issue. So typically for a married couple, we tend to see inheritance tax as a second death issue to try and manage. There is a nil rate band, which is the amount you can pass on free of inheritance tax. Each individual has a nil rate band of £325,000. And that can be claimed on second death if the first death or spouse to pass away first did not use that. So that's a £650,000 allowance for a married couple. Over and above that, in recent years, they brought in the residence nil rate band, where you're passing on a residential property that you live in to direct descendants, children typically, which is another £175,000 per individual. And again, that can be claimed on second death. So if you add those together, £325,000 plus 175 is £500,000 for a married couple. That's £1 million. That's your headline on the front of the paper when they brought that through many years ago. Just a point of note, really, once your assets, including all assets, business, etc., exceed £2 million, then actually that residence nil rate band is tapered, a bit like the personal allowance. So for every £2 over, you lose £1 of that allowance. So once a married couple gets to 2.7 million, effectively, that residence nil rate band doesn't apply anymore. I've got an example to touch on there. Business relief, many of you will have privately owned businesses, shareholders in those businesses, and really since 1976, which coincides with the year I was born, that there's been 100% relief on qualifying trades. So you might well be familiar with that. And then agriculture property relief, again, A similar exemption, again, uncapped as was. So that was pre-April 2026. Where are we now? So we have frozen nil rate bands, frozen residence nil rate bands, and the plan is to freeze those until 2031. So that's 16 years in totality where those nil rate bands haven't been increased. And that's what we were talking through at the seminar last time. Really, that's this kind of element of fiscal drag where people are paying higher levels of tax, more estates are being dragged in because their assets are inflating at a much greater rate than the allowances. From April this year, the cap is now in. So instead of being unlimited on qualifying trading business shares, that now is capped at 2.5 million, where it's 100% relief. So no inheritance tax up to 2.5 million on qualifying shares. And over and above that, the rate applicable is 20%. Same goes, it's a combined for agricultural property across the business and personal. So if you've got a husband and wife, they've got 5 million of kind of relievable assets before the inheritance tax starts to bite. And then when it does bite, it's effectively a 20% rate rather than a 40. But still, massive shift for some of our kind of valuable business owners, and certainly kept us busy. Over and above that, shares listed on the AIM market, they don't get a 2.5 million allowance, but they're an effective rate of 20% inheritance tax. And a very big one for us here in the wealth team is that pensions will be included into the inheritance tax calculation from April next year. That can really have some quite difficult tax outcomes, which I'll talk about shortly.
Well, some big changes there. Do you have an example that you can show how it works for us in the realms of tax?
Absolutely, absolutely. So again, I'll run through an example now. So it's more clients, more tax, more reason to plan, ultimately. I'll run through an example now, which hopefully shows you how painful it can get. So simplistically, client has £1 million property, £700,000 in cash and investments, and a pension of £1,050,000. The estate there, because until April next year, the pension is not included in that estate, is 1.7 million. So the chargeable estate is 1.7 million. Client has nil rate bands of 325 times 2. They're a married couple in this scenario, and they have the residence nil rate bands available to them as well. So there's £1 million that comes off that chargeable estate. So the taxable estate is 700,000. The inheritance tax today would be 280. Once we get through to April next year, we have the pension added back in. So that puts the chargeable estate at 2,750,000. You've got 650,000 allowances. But if you remember, I was talking about this kind of taper on the residence nil rate bands. Because the assets now are more than 2.7 million, you've actually lost that £350,000 allowance. So estate is now subject to IHT. So you've actually got an £840,000 IHT exposure now, which is a 560 increase because you've got the 40% on the pension, plus you've also got the effect of losing the residence nil rate bands. So just to kind of bring that home a little bit further, if somebody passes away post 75 with leaving a lump sum death benefits, pension £1,050,000, you'd lose 40% in inheritance tax. A further 40%, say that beneficiary was a 40% a higher rate taxpayer, they would lose 40% on the residual fund when they draw it out. And also, in this example, we're losing the benefit of the residence nil rate bands, which is actually a hard cost of 140. So if you net that off and put the burden on the pension, it doesn't quite work that way in practice. But if we use that as the example, you net 238 from the £1 million pot, which is pretty painful. Like I say, we're assuming the beneficiary is a high rate taxpayer, and it is that 140,000 loss there is the effect of 40% of the 350 allowances, which are no longer available.
Wow, that's a thought-provoking example. Really gets you seeing how it applies in the real world. What's the best approach for clients who are concerned about this for themselves?
To start to consider to plan, really. I mean, there's 4 typical approaches that we tend to see. We could do nothing. just pay the tax. I think HMRC would prefer that out of all the options, but effectively that is significantly reducing the inheritance tax to, sorry, the legacy to the next generation. We do see some clients that just feel that they don't want to plan, they don't necessarily feel motivated to reduce the tax. Typically, they don't tend to be talking to us that much, so but that certainly is an option. Option two, you hear this kind of phrase skiing, spending the kids' inheritance. It's certainly a valid thing, but it's a couple of things that kind of prevent that to some degree. You've got to spend it on money that has no real value. So spend it on assets and things that have no real residual value. So yeah, things like world cruises, particularly expensive cars with there's a lot of money in the short term. But then that's also got to be tempered by what money you might need access to fund your lifestyle in the future. Giving it away, obviously it's very valid. We're going to talk about that in a lot more detail, and we're seeing that already. We're seeing some of that behaviour change and some of those transfers accelerated to children and grandchildren. And we'll talk a bit more about the rules around gifting, etc., and why we might not choose to gift to individuals. And it will look really today at some of the planning options, really, which we can talk through and consider.
So there's plenty of things that clients can do to reduce their inheritance tax exposure then.
Absolutely, absolutely. In fact, Roy Jenkins, he was kind of famous for this kind of quote standing up in the Commons and kind of saying that inheritance tax is effectively a voluntary tax. And you can see where he's coming from in that, if you do give those monies away, then you can reduce your exposure as long as you're, able to live the life that you want to live and life hasn't got in the way. So in practice, it becomes a little bit more difficult.
Wow.
Just to touch on some of the other allowances that we consider in some of our planning, there's an annual exemption. Each individual can give away £3,000 per tax year. That's by the donor. If you've got 5 kids, it's still only one £3,000 allowance. Some small gifts allowance is some gifts for marriage from parents and grandparents, and quite a valuable one, which we're not going to dwell on too much today, but it's certainly worth thinking about in any planning that we do, is the ability to gift out of excess income. So where you have income which is demonstrably surplus to your expenditure and you give that away on a habitual basis, that is actually immediately exempt from inheritance tax. So really good record keeping is essential with that. Over and above that, like I mentioned, the gifts, the classed as potentially exempt transfers. We'll talk about that in a second. Business relief, again, we'll talk about that a bit more. And agricultural property relief, and like we mentioned, transfers between spouses are exempt.
Okay. Can you tell us a bit more about the inheritance tax gifts and the purposes?
Sure, no problem. So potentially exempt transfers. So how they work. This is myself making a gift to my children or to my grandchildren. Typically, it's not out of access income. So this is a gift of capital. That's direct gift to children. Once I have survived 7 years from the date of that transfer, that would be exempt, providing certain conditions are met. So if I pass away in the first 7 years, typically it's in my estate. After 7 years, it's outside. There is taper relief, which is a much misunderstood relief. So you do get a reduction on the inheritance tax on that gift, not on but just to understand that, if I give away £325,000, typically that will use my nil rate band if I passed away within 7 years. So there's no taper on that. If I gave away £500,000, typically there'd be the first 325 used the nil rate band, and there'd be some taper relief after the 325, so 175 would start to be reduced by taper relief in years 3 to 7. But that's much misunderstood. We see it particularly not well commented on in the press. And there are conditions. You have to genuinely give that asset away, that son away, that property away, that cash away, and have no strings. You can't say. The clearest example of that might be, I live in a property, and I want to give that to the kids, but I want to carry on living in it, that clearly would fall foul of the gift and reservation rules and a number of other pre-owned asset tax and other rules. So it needs to be a bona fide gift. And then we need to think about things like the probability of surviving 7 years. I talked about, making sure we have enough to fund our lifestyle today. The reason why inheritance tax is still payable is because we're all trying to work out how much we need to live on. And then that's what the kind of financial planning process seems. By the time we know much more about what our remaining days on the planet might look like when we're in our kind of late 70s, 80s and onwards, our chance of surviving those gifts obviously significantly reduces over time. So what this is telling us here, so the chance of an 85-year-old living 7 years, ONS statistics, would be 26%. So it's not a bomb-proof plan to say I'll just leave it until such time I'm ready and then I'll give it away. So yeah, outright gifts do work, but you do lose control, you do lose access yourself during your lifetime. And obviously, once you're ready to do that, it might not work for you. Over and above that, it might be that the person that you want to make this transfer to might not be quite ready to receive the gift, or you might not want to give them large sums at this stage for any number of reasons.
Great, thanks, Glenn. Andrew, do you want to tell us more about the trust approach?
Yes, certainly. Um, so trusts have been used for centuries as a means of passing on wealth and also as a means of actually reducing tax duties levied on capital. So very long, if you like, pedigree of being used for tax mitigation. The main advantage from the current situation is that property is placed outside your estate. So it can't be aggregated with your estate on death, unless, of course, there's a gift with reservation of benefit. It gets the 7-year clock starting, and that starts from the date of the gift. It's not a death thing, though death obviously plays a part in actually, as regards to the rates of tax that could be imposed later on. And again, going back to its huge longevity as a means of protecting wealth, its value is protecting vulnerable people. And that will include children under the age of 18. It'll also include people who are disabled, for example. So very, very important means of protecting people in the long term. Now we come to asset protection. Asset protection, certainly in the past, was represented as being a very important factor. But you have to bear in mind that things have moved on a little bit, and in terms of protecting wealth on divorce, for example, often the court will take into account the existence of a trust as a means of income, if you like, or support for one of the parties. So that can be taken into account. You also have situations where the bankruptcy rules can actually be triggered if somebody was trying to put their own assets beyond the reach of creditors. However, if you're trying to do this to protect people, particularly young people, let's say, from experiencing bankruptcy, setting up a trust is an ideal way of doing that. And again, it can be used in a whole variety of different situations. It's also very important as a means of avoiding probate as regards certain assets which have been settled. Now, the final point, which is actually, in my experience, actually a key major aspect, certainly for parents or grandparents, they absolutely like to have control and access over the capital that's going to the younger generations. And I think in a large number of situations, that is actually a very valuable way of actually protecting the family wealth moving forwards.
Andrew, for some of those less familiar with trust, can you cover off some of the basics for me?
Yes, absolutely. Um, so it all starts with a settlor. That's the person who's passing on wealth into the trust. And it's literally as simple as that. the thing you have to bear in mind as regards the settlor, he has to make a gift, which actually will be governed, the form of the gift will be governed by the nature of the assets being settled. So that's another key point that you have to bear in mind. It's actually quite a technical area, and it's one where we work very closely with legal advisors to ensure that the property is properly settled, that we've got evidence that actually proves this, and so on. Now, trustees, the basic rule of thumb is absolutely anyone, pretty well over the age of 18, with sufficient mental capacity can be a trustee. So anyone can be a trustee within broad terms, even corporate entities can. But in reality, it's very important, certainly in a family situation, that you have family members involved, but equally well, it's important to have professionals involved to help with those difficult legal issues that can sometimes arise. Now, in terms of beneficiaries, again, with the type of trust that we deal with, typically discretionary in format, they're going to be drafted on the basis that a class of beneficiaries can actually benefit from the terms of the trust. And that allows maximum flexibility because it will permit the trustees to pick the best candidate amongst those class of beneficiaries who can benefit from the assets that have been settled. Now, a very important thing, sometimes overlooked, is the memorandum of wishes, because it's very important that the trustees take into account the wishes of the settlor, and quite often these will change over the course of time before, let's say, a will trust comes into play. And he or she is able to actually pass on the benefit of their wisdom as regards the best way of looking after the beneficiaries who will ultimately benefit from the capital that's being settled.
So how might one compare the use of trusts versus gifts to individuals?
Well, in many ways, a gift to an individual is the simplest, cleanest way of actually passing on wealth. The trouble is that you have all the downsides that go with that because people are people, and you'll find that there could be an exposure to, let's say, bankruptcy related issues. There could be an exposure on divorce, let's say. You've also got a situation that when gifts are being made to minor beneficiaries, generally those will be settled under the terms of a bare trust to look after it for the benefit of the beneficiary until they reach 18. But at 18, they basically get the reins. They can do what they want with that particular fund, if you like. And that isn't always the best thing to happen. So it could be that it would be helpful to have someone to take away the responsibility of dealing with the funds or some of those major decisions by having them settled in trust subsequently. So discretionary trust, there's actually a very important reason why people use discretionary trust. It's in the context of capital gains tax. You can make gifts, let's say, of private company shares, trading company shares to individuals and benefit from a form of holdover. But you don't have that level of restriction as regards making gifts of assets to discretionary settlements, and you can hold over the gain. And what that means is that the trustees will get the asset at your basis of value. In other words, your acquisition value as regards that particular asset, the gain is deferred. So quite often you'll find situations where an individual might want to make an outright gift of an asset to a person, if you like, a child, but they actually decide to do so through the medium of a trust in order to benefit from holdover relief. Discretionary trust, very, very flexible. You can have very wide classes of beneficiaries who can actually benefit. Very important, as we've said earlier, that the settlor shouldn't be capable of benefiting under the terms of the trust for a whole variety of different reasons. And you'll find that as regards the individual taxes, the actual shape of that exclusion changes. So, for example, for income tax purposes, the settlor and spouse should be excluded from benefit. As regards holdover relief, that would include settlor, spouse, and children under the age of 18. And so it's quite a difficult job in some respects, getting the terms of the trust to actually accord with all these exclusions. And it's a skilled job in drafting the terms of the trust to ensure that they work in the way that you want it to.
Great. Thanks for that, Andrew. That's really useful. I think the next bit, with the trust planning, I understand there are a number of options for clients with differing needs. Could you touch on that, please?
Yeah, of course, of course. So yeah, so obviously in the wealth team, we've been, providing inheritance tax planning advice for many, many years for our clients. And where cash is available typically, so there's surplus cash available, there are a number of different trust planning options which we typically put into place. One was the straightforward gift trust, which is really what we've been discussing, and Andrew has been kind of talking through some of the rules there. Gift trust is really, I'm transferring some money from myself to the trustees today because I want to start that inheritance tax clock ticking, and I'm happy to give up my access to those assets. Once I've survived 7 years, those funds are outside my estate. So that allows me to retain control, decide when the beneficiaries actually do get access to those assets at a point in the future, though obviously for inheritance tax, I no longer have access. So I'm happy to give the assets away. We'd use a straightforward gift trust. For those clients that aren't happy to give assets away, we might use a loan trust. And that's where a client is aware that, they might be taking investment advice from ourselves and their assets are growing over time, and they might say, well, actually, I'm not happy to give the capital away, but I'm happy to give the future growth on this asset away. And what you're doing there is I'm loaning the money to the trustees, and the trustees are investing that money. The growth on that money is outside my estate from day one and is growing in the trust for the benefit of the beneficiaries over the years, whilst I can still draw back on that loan if my circumstances change or if I need some access in the future. What's really neat about that planning is it allows you to start some planning now with confidence, not happy to give the capital away, but I am the growth. I know I can draw down on it. 5 years' time, I might see the world differently. My circumstances might have moved on and my needs might be better known. I might write off that loan. At that point, the kind of writing off of that loan is effectively a gift for inheritance tax purposes as well. So another kind of tool in the armory, really. Some clients will want a fixed income. So there's a vehicle called a discounted gift trust. Effectively, that allows you to gift capital into trust today and set a predetermined income or kind of return of capital coming back to me every year for my remaining years on the planet. Typically 4 or 5%, and we tend to use investment bonds as the underlying trust investment for these vehicles. It has the added benefit of actually, because HMRC will see that I'm getting a predetermined level of income back every year, they actually give me an immediate discount on that gift. So I might put 325 in, and the actual discount might be 120, 150,000 pounds, depending on my age and what HMRC think I might get back. So there's a significant immediate inheritance tax benefit. But again, it's got to be right. You've got to need to want those reversions that are coming back to you, and you've got to spend them, because we've seen advisor firms put these in place because it's a product, and then that money's just accumulating in their bank account when it comes back to them, which does nothing for inheritance tax really. So it's just making sure you've got the right vehicle. And then another kind of HMRC recognised instrument, really similar to the discounted gift trust, is the flexible reversionary trust, where I'm giving capital away today, but I might want access in the future. And so in 3 to 5 years' time, I might say I want the option to have 30% back as a carve out, as a reversion. In 5 years' time, if I want that back, I can do, or I can defeat that maturity and push it back again. But the gift reads back to day one of the transfer. So Again, where clients aren't quite confident to make those full gifts, there's another vehicle there that we can use, and then kind of just bringing that together. If we can give the capital away, yes, okay, gift trust is probably going to be something we want to consider. If we don't want to give the capital away, but we want the future growth outside of our estate, maybe the loan trust is something we can consider. If that's not quite right, then we need an income. Maybe we consider a discounted gift trust. And if we want some sort of hybrid, flexible approach, then maybe the flexible reversionary trust. But again, it's all about the financial planning process and help our clients understand these options and what might be best suited for them.
Great. Andrew, are there any opportunities that could be considered?
No, absolutely. And just perhaps before moving on to that, with all the ideas that Glenn set out, they have a long provenance. So, for example, I remember probably about 40 years ago, there were precursors to the discounted gift trust arrangement. I think they were called pure endowment term assurance plans, as far as I can remember. And it's very reassuring to have the commentary in the manuals actually supporting all of these products. They offer a very, very valuable solution to clients, a degree of certainty in a uncertain world, if you like. But it's also possible to have bespoke arrangements. And we could, yes, thank you, possible to have more bespoke arrangements. One possibility is to have a jointly settled trust. And it's in instances like this, we would rely very closely upon the assistance of a client's solicitors to actually help us. But in simple terms, it means that you could have a single legal settlement, but it's got two settlors. You've got husband and wife in this particular example. And the quirk here, if you like, is the Inland Revenue would recognise that as being two separate inheritance tax trusts. And so it would mean in this particular example, assuming that neither spouse had actually made any gifts at all in the previous 7 years, other than of an exempt nature, it would mean that that single legal settlement would have two basic rate bands which could be relied upon to actually protect value. So that's actually quite it's quite a useful structure for some people. You could see situations that if husband and wife had funded and owned equally commercial premises, for example, they could make a transfer of those commercial premises into this single trust. They would have the benefit of holdover relief, provided that they were excluded as settlors and spouses, but also all their minor children were excluded as well. But the value of that is that you could have a single property placed within this trust. And again, the oddity about it is because they are separate trusts, you get a level of discounting as regards the separate interest held by each separate trust for inheritance tax purposes, which could be in the region of, say, 10 to 15%, because of the valuation discount, because they would be separate owners of this property.
Be right in saying as well, would I, Andrew, that it's clients will often use 325 of the kind of settlement into the trust without any charges on the way in, which resets after 7 years, and they might have like a rolling gift strategy where they make a transfer.
Absolutely right. I think the important thing with all of these strategies, it's a continuing process. It's not just you do it once and that's it and move on. I think that's actually a topic that we'll touch upon in the final webinar dealing with business property and agricultural property relief. It's becoming a regular continuing flow of planning as the best way of preserving family wealth. Absolutely right.
Great. Are there any other opportunities people could look for, Andrew?
There's a slightly more complicated one, which which is this one here. So all this is basically saying, because of the way that you calculate the charge to inheritance tax as regards individual settlements, You can make a gift of, let's say, a small amount of value into one trust. It takes into account the settlor's previous history of transfers. So we're assuming here that the settlor hadn't made any transfers of value, i.e. gifts, in the previous 7 years, other than of an exempt nature. But it would mean that it's dragged with you, if you like, together with that property, the balance of the individual's nil rate band. So if we just continue with this process of having a trust, which could be set up years later, months later, all you're doing is you're actually continuing the same process. So in this example, we've got 3 settlements for a settlor's 3 children, ultimately designed to be, they would obviously be adult children, being designed for their families. You can actually show it quite a significant amount of value with those collective nil rate bands. And in this illustrative example, it was 825,000. Now, obviously, life isn't quite as simple as this, and it requires a degree of planning to actually put this into effect. But it shows you how flexible these structures can be.
Great, thanks, Andrew. Glenn, are there any other non-trust based strategies that you use with clients?
Yeah, I think probably collective sigh of relief on the non-trust element of the book of the planning now. So I just business relief investments. I'll touch on this briefly. So effectively, business relief investment is an investment in a qualifying trade, which is typically an unquoted company, sometimes listed on the AIM stock market. There's a relief, as we mentioned earlier on, for business relievable assets that qualify, 100% relief on the first 2.5 million and 50% uncapped on the balance, which just came in April this year. AIM don't have that first 2.5 million allowance. And effectively, it's a holding period of 2 years to achieve that relief, which is a significantly faster benefit than surviving the 7-year potentially exempt transfer rules. And they must be held at the time of death. So you've made an investment into a qualifying investment, which is then subsequently held by you at the day that you pass away, and that exemption kicks in. If you've owned assets, so you've got that 2-year holding period, but if you've owned assets that were qualifying in the preceding years and you've sold those, but you then reinvest in more qualifying assets, then you actually that they are immediately relievable from inheritance tax. So we quite often see that when clients are selling businesses and they want to go from a trading company where they have had an inheritance tax exemption, but now got a pot of cash, they're exposed, and we can reinvest that into a built for purpose vehicle. Key thing with this one really is that the individual has access. You haven't given anything away. There's been no transfer to trust. There's been no compromise in that regard. You've just simply changed the nature of your investment. One thing to watch out for is obviously the investment risk, that these are smaller companies and do carry a risk with them, which we kind of shepherd our clients through that process. And if they're not managed effectively and their qualifying status is lost, then you do lose the benefit. So again, we've worked with many providers for decades in this particular area. And just to kind of bring that home, we're looking at what we hear, we're looking at a 7-year survival likelihood for different ages versus a 2-year survival. So you're saying, because once you reach the age of 85, you're still 75% likely to survive 2 years, whereas that falls to 26% to survive for 7 years. I've got an example, which I think is probably worth just kind of touching on there. So in this instance, we've got Mr. Robertson, who's 85. He's shortened life expectancy. He's got IHT exposure of around 800,000, which is due to his estate, which is made up of property, £1 million investment portfolio, largely in ISAs, which is great. He's been prudent in his kind of using his allowances over the years, and a further £1 million in cash. Challenge is not that likely statistically to survive a gift at this point in time. And there might be, say, a power of attorney in place, and certainly powers of attorney make gifting quite difficult, as you have to try and demonstrate that is in the best interests of the donor. And ISA holdings fundamentally, they're great from a capital gains tax and income tax perspective as you're growing wealth over the years, but they are not exempt from inheritance tax. So there comes a point where that kind of tax logic starts to fall away. If we were to use some of the money to invest in a business relief qualifying investment, effectively the managers that we use are using asset-backed structures. So I'm not talking about AIM here, I'm talking about asset-backed investment structures, which could be loans or other mechanisms where there's an underlying asset to secure the value and the capital preservation focus. They would be qualifying and therefore exempt after 2 years and can be implemented under the power of attorney, whereas, like I say, a gift is quite difficult to implement. The settler retains access, so they could sell at any time in the future. And then that £1 million example, we've saved £400,000 in inheritance tax following the kind of necessary holding period.
Interesting example. Is there anything else that can be considered?
Yeah, I guess the path of least resistance really is something like a whole of life insurance plan. I'll just run through how that works. So this really is a insurance policy where many of us think of insurance policies as being term policies. So they're to protect our mortgage or a liability of some sort. This is actually, and that finishes in line with that liability finishing, the mortgage finishing or otherwise. Ultimately, this would pay out in the case of a married couple on second death, which is obviously where inheritance tax bites due to the spousal exemption. So you have an insurance policy written for all of our life and paying on the death of the second life assured. The sum assured broadly is there to match the inheritance tax liability and or certainly contributes to it. Funds are available pretty quickly. There's no delays of probate or otherwise where it's fairly straightforward to demonstrate somebody who's passed away. And the fact that these policies are written in trust means the assets are outside of the estate for the purposes of inheritance tax, are providing a lump sum for the next generation. And ideally, premiums would be paid out of excess income. So there's a further inheritance tax efficient element to that. Need to make sure that we, make sure those premiums are funded for life. So in the planning that we conduct for our clients, we're making sure that those premiums are sustainable and affordable. The attractiveness of that insurance policy is very much down to the underwriting process at outset. So ideally, we want a clean bill of health, non-smoker in an ideal world, but we still put policies in place for smokers. So when we might use whole of life, it's where planning doesn't reach. So we might not want to, gift any more away or put assets into trust or use business relief vehicles. It might be that we're asset rich and cash poor. And, we see plenty of clients with large property portfolios where they might be reluctant. They might want the income from those portfolios still, and they might not want to crystallise any capital gains tax events by selling the properties today to give the cash, and because they might not then survive the 7 years. There might be, and it could just be certainty of outcome. Some clients use these policies because they want to have a defined benefit going to the next generation. They know what that is, and if they end up spending the rest, then so be it, really. They know they've got this nice big policy that they put in place for the kids, and they can sleep at night knowing they've done their bit. So there's all sorts of applications of these policies.
Do you have an example of the pricing to show the costs and benefit of this type of insurance route?
Absolutely. We do a lot of this work, basically, with clients because it needs to make sense. It's all very well and good. So if the premiums are unaffordable or just don't make sense, we wouldn't do any of this. So it's like I said, we're providing for the bill, we're not mitigating it. So in this example, I've got Mr. and Mrs. Robinson, 65 years old and are in good health and non-smokers. We're putting in place a policy for £1 million to match their liability. That's written in trust. So it's become the property of the trustees from day one. Typically, those beneficiaries are going to be their children, as you can imagine. So I quote there, this is a real life quote. A monthly premium would be £1,374 a month, or an annual premium 16,500, rough figures, which is a significant sum, but so is the £1 million cover. So if we pass away the following day, having put this policy in place, we paid one premium of 1,374, and we have a proceeds payable to the next generation of £1 million. Now we use guaranteed premiums policies, so we know what the premium is, we know what the sum assured is, we just don't know how long we're going to live for. So that's where we try and understand how much value there is in this exercise. So if we think of these clients, 65 in good health, ONS life expectancy says 86 for second death, which is 21 years time. And by 21 years, we'd have paid 21 premiums, annual premiums of this figure here, which is 346,000. So we've paid 346,000 in, and we've got £1 million out. Another way of looking at that is if we didn't take out the policy, if we invested the monthly premium on a monthly basis and got a 4% per annum net of fees and tax return, risk-free, the investment at life expectancy, 86, would be 543,000. Okay, so we've got a 543 again versus £1 million. Of course, we might go on, and most likely a lot of our clients do go on to outlive average life expectancy. But if you look at premiums when they might be equal to sum assured, that's when second age is 126 years. So when you try and bring all that to some sort of value calculation, we've got £1 million policy, which is this flat line here. That's the life cover. So these are the premiums being paid or the investment. If we look at the investment, well, if we look at the premiums, cumulative premiums, which is the blue line, you never really catch up. We're at 112 and we're still way off catching up into what the policy will actually pay out. If we think about it from an investment perspective as an alternative, the crossover there is kind of in the 90s. We've had all this benefit of significant margin of safety throughout the process. If we think about it, if we've invested that money, we've likely got that in our state for inheritance tax purposes. So we need to take 40% off that, which pushes that value out as well. So you can see that for some clients, these are really good just as an investment for the next generation, rather than just simply being an insurance policy for the inheritance tax.
So there's lots of options, really. What approach do you use to help clients start their inheritance tax planning process?
Absolutely. Because we've seen lots of options today, and they are just options. No one should take any action based on this, because the outcome, the correct solution, is highly bespoke and highly personalised. Ultimately, we need to consider, so I'm mindful of time, I'm just one eye on the clock here, and I know we want to have a few questions afterwards, so I'm just going to nip through this kind of financial planning process, but hopefully it helps you understand how to take a client from knows they've got an inheritance tax liability through the process to get the right solution, the right outcome for them. So we consider your assets and liabilities, the life that you want to live, any nuances and preferences, any attitude to risks, family dynamics. We know it's really spending time building really deep relationships with our clients to understand and validate the advice, make sure we're using any allowances and reliefs, and then we start to model out what the future might look like and what the impact of any actions that we take. And then we think about things like specific pensions and what their changing role is post-April next year. And then all of that brings together a plan which gives us the confidence to act now. Just kind of flipping through here, really, what are we going to consider when we're thinking about your assets? We're thinking about what you own, we're thinking about your residence, your second properties, your investments, your pension wealth, your interests in business, short-term cash reserves, personal effects, jewellery, etc., and obviously taking off any liabilities, so we get a bit of a clear picture of where inheritance tax fits now. We also want to see how that inheritance tax picture might change over time. So what's your income like now? When will that stop? Will you have any future income? What's your state pension provision? What are your other pensions? How are you going to live in retirement? If you're going to sell a business at some point in the future, we need to model that and think about that. We might have a business that's exempt from inheritance tax today, but once you get a big lump of cash, you've got a nice big IHT liability. What are we going to do about that? We do a lot of coaching of clients that go through business sale and business exit and how they prepare for for life, and also assets from up the generation as well, really. What might be receiving from our parents, and is that structured correctly, and does that make sense in the plan? So every plan starts with our clients, starts and ends with our clients ultimately. Then we've got to look at what do you want to live in? Obviously, particularly if you sold a business or we're now retiring, how are we going to live? Are we going to buy a property? Are we going to buy a second home? What cars and vehicles? We really spend time with our clients trying to understand where their money might go, because we need to have good information going into our modelling in order to get good outcomes on the way out. Thinking about sabbaticals, anniversaries, bucket lists, holidays, other lifestyle expenses, and then really children and grandchildren. What are we funding for school fees, university fees for kids, our kids? So it's really all of this goes into the modelling and the thinking piece to make sure that what we then do, which are those solutions we touched on earlier, are the right thing at the right time. So yeah, we need to think about your preferences. Is your lifestyle funded? Do you feel comfortable out gifting? Are the children ready to receive? Quite often our clients are concerned about the position of their beneficiaries. They want to make sure they still have purpose of their own and drive of their own. So they don't want to give too much too soon. They might be concerned about the security of their relationships. There's all sorts of reasons and elements that we need to consider in the planning process, how much control they want, and of course any philanthropy really. And so all of this goes into the mix. So we model all of this. You'll get copies of the slides, and we think about and we stress test and we think about different scenarios, and that helps us validate and come up with the right plan.
Great. So, you got any further comment on pensions and actions that could be considered?
Yeah, I think again, it's all part of the modelling. Inheritance tax on pensions is a big shift, so we need to consider what we do. If we just strip it all out of our pension, we couldn't pay 45% income tax on it, so we need to be careful. Certainly, clients we're seeing the benefit of consolidation. Inheritance tax have to be paid within 6 months of someone passing away, so the complexity of dealing with multiple different schemes who are in turn running to keep up and catch up with the changing rules, and we don't want to, have interest owing on inheritance tax benefits. So there's a strong case for consolidation. We need to consider our expression of wish that's attached to the pension. Certainly, is that right? Is that structured well in the context of the wider estate planning? And maybe you want to withdraw earlier, and we're seeing that. I think a lot of this strategy, of the Treasury and the tax rules changing is about inheritance tax on pensions, but actually it's about behaviour change, and we're seeing that where people are accessing their pensions much sooner and trying to plan sooner with them, and like to give to capital or individuals, etc. Ultimately, what we want to get to is a net legacy in our model. So by taking this action, by withdrawing money from the pension, maybe suffering income tax or and then gifting it, what does the net legacy look like over time? And again, that's something we walk clients through.
Great. So we've heard from yourself and Andrew throughout the webinar. Can you tell us how the two disciplines of the regulated financial advice and the tax advisory planning side of things complement each other?
Absolutely. So again, the role of the financial planner, we're regulated by the Financial Conduct Authority. So we tend to drive a lot of the relationship with our clients, really spending that time on the cash flow modelling, etc., to really understand their wants, their needs, their resources now and in the future. Ultimately, we might get to investment advice and managing the client's wealth. But like I say, that's if you're a proper financial planner, it's not about going for the pension investment or any other investment first. It's about validating what the client has through a financial plan, and then that informs the investment, whether to invest, not to invest, and how to invest. Obviously, again, that leads to recommendations and ongoing portfolio management. And then typically where we manage our clients' wealth, we're annually reviewing that, making sure that it's in line with their objectives and those objectives haven't changed. Speaking for Andrew and the tax team here, bit Paisley, but from the tax side and the benefit of working with us as a group and a combination of professionals, and quite often with lawyers in the room as well. The tax team bring the advice around complex structuring, trust establishment, ongoing trustee tax compliance, tax returns, TRS, etc., the registration service. And working with our legal partners on will drafting and probate, and then obviously any engagement with HMRC that might be required over time, and coordinating that and position.
That's great. Thanks for summarising that. So, out of all of this, what's the final takeaway for clients from this webinar?
It's very much, we're all unique. So you might have an identical set of circumstances. You might be the same age as your friends that live next door with the same kids, the same age. You will have a different outcome, a different set of objectives, a different set of preferences. So it really is tailored. It's not off the shelf. The mix changes over time. What we do for clients at 60, when there's so much more life to live and go and so much more time to travel down the track, is very different to what we might do at 80 or 85. And that is how inheritance tax planning evolves. It works well to start early. As we've mentioned, some of these kind of effectiveness of these solutions is time dependent. So starting earlier, but having the confidence to do that by going through a planning exercise is the best approach. And review regularly. Things change over time. Governments change. We've seen that post October 24 and everything that we're trying to digest and consider now.
Great. Thanks for that. So I think we're coming to the end of our webinar. We've got a couple of questions that have come in. So thanks everyone for listening. What we'll do is I'll read through them, but it won't be a whole advice thing. We'll try and cover off what we can in the time that we have. One question come in, I think it's probably for yourself, Glenn. Can you put a SIPP into a trust and then benefit from the income afterwards?
No, ultimately. So a pension is an individual contract, much like an ISA. The tax rules are very much linked to that as an individual. You can direct the death benefits to trust, which does become quite complex. It is probably a little bit less tax efficient because it triggers the income tax on day one. The beneficiary might pay. So yeah, I'm happy to kind of take that question offline with the individual. So typically, no, you can't transfer it away and still benefit from that pension yourself. There is something you can do on death, but it is not the most tax efficient route.
Okay. I know we've seen questions coming throughout, like people moving offshore. Is moving offshore a way to eliminate and reduce inheritance tax now? Obviously, all the inheritance tax rules have changed around tails and stuff. So I don't know if you just want to touch quickly on that at all, just to cover off anything.
If I pick that up, so the rules have actually changed. There used to be domicile based, a legal concept, which links you to a particular jurisdiction. Now it's actually residence based. And so if people come to the UK, for example, and they've been non-resident for 10 out of the last 20 years, yes, they can certainly do things in terms of mitigating inheritance tax, which they couldn't do before. So just an example, a guy who is living in the US and working there, coming back, it was rather surprised to know that despite the fact he was a Brit, there were some inheritance tax breaks that he could actually adopt simply because of his resident status.
I think it comes down to careful considerations are needed if you're in that type of scenario. I think is the gist of it, isn't it? So
it's quite a long tail, isn't there? It's not just get up and move sticks
leave.
And then the inheritance tax disappears.
Correct. And that's the thing with the whole rule changes. It's not just a case of I've left now. You've got to look at your position individually. Just going on to, I know we touched on gifts out of income. We've had a question coming in. What's the best way to keep records to make sure they're robust?
If I pick, well, in fact, Paisley, you could pick that up. It's an area that
we see it all the time, don't we? So generally speaking, whenever we talk to anybody about gifts out of income, it's the records, yes, they have to be risks, they have to withstand a probate, etc. when you're doing inheritance tax. The best way to really do that is HMRC have a really good form that you can continuously use every year. It's making sure that you document that you are giving it out of income, listing the beneficiary, that it's going to, the date, the amount, that you keep those detailed records for every gift that you make. It's also relevant that you keep a an actual log of your income for the year as well, because you've got to have the two together to prove that it is actually a gift out of income. So, you know, you it's nice to keep it nice and clean. You don't have to go as far as having separate bank accounts for this. It's all in the level of the detail. If you have supporting documents that back up the payment to the beneficiary in your lifetime, then it's nice to keep it. I always say to people, keep it with your will. Make sure people know where you keep these records, because there's nothing worse than when someone passes away and then nobody knows where anything is, and then the solicitor, the lawyers have to pick this up and try and unravel it. It just becomes very costly. So you can do a lot in your lifetime to keep those records to make it easier for the next generation.
And I suppose just to add to that, you can actually make sure you set it up very carefully to begin with. What people should do is have a memorandum of the potential beneficiaries that they're going to give the money to. They should allocate a certain amount of their income, which they can afford to do on a regular basis. And then it means that you can actually make a gift, not well, actually to one person within that group each year. You've got total flexibility. So that's actually a strategy based on case law.
Yeah, it's all about placing what you're doing with the exemptions that are available. So, yeah, keeping everything detailed is what's key, isn't it? I think we are pretty much coming to the end of the webinar. Those were the questions that we've got to come through, so I thought we'd do those first from the watchers. So our next webinar in the series, webinar 3, is on the 2nd of July at 12:30. We will be circulating the invites for that in due course. Likewise, after this, the link to you can watch this back again because it's been recorded will be circulated to everyone that's been registered and so on. But just want to say thank you for everyone for watching, and hopefully you found it interesting and thought-provoking. So we look forward to seeing you on the next webinar. Thank you, everyone.
Thanks very much.
Yeah, bye now.